Hello and welcome back to a weekly market recap. I'm Knight. Let's get to it. So this past week, we saw the market recover a little bit, back up 2.7%, which brings us up year to date 16.91% in the S&P 500. Now, we'd been talking about for a while, we have not seen a 5% decrease for the whole year. Well, we finally got that, and it was in the 7% decrease. However, with the recovery of 2.7% in the market this week, we've actually jumped back up and we're now under a 5% decrease from our former high to our current value. But let's talk a little bit about why the market rebounded. What were the main catalysts for the market this week? So the biggest surprise actually came out on Thursday, as we'll see. Republicans came out on Thursday and actually said we're willing to negotiate and approve the debt ceiling until the end of November. Now, this was shocking, just genuinely surprising, because it seemed like the Republicans were on pace to stall out the debt ceiling. So that way the Democrats were going to have to combine the 3.5 trillion infrastructure plan with the debt ceiling for the reconciliation that would have had to happen within a week from now. So by October 15th. Now, with the Republicans saying we're willing to extend the debt ceiling until the end of November, that gives the Democrats almost 7 weeks now to get the $3.5 trillion and the debt ceiling extended together for the future. So that means the debt ceiling they have until the end of November, which means at the end of November, they would have to pass it as part of the budget reconciliation. But again, that gives them 7 weeks to combine the $3.5 trillion infrastructure bill and the debt ceiling. So really shocking. And the market was not expecting it. And neither was I, frankly. Then on Friday, we had a mess of a jobs report. Now, September was the big month where everyone was expecting, all right, we're going to have amazing jobs added. People are going to not have their federal unemployment benefits. They're going to go back to work. COVID, Delta variant, still kind of a thing, but not as much. It was waning. We're going to get a lot of jobs added to the market, but we'll talk about that a little bit later. So if we jump into the market, what we see is actually some volatility to the downside at the beginning of the week. So Monday, we saw a sell-off. Tuesday, we got private jobs added. So that's the private payroll jobs. And it actually came in with some positive sentiment. So we saw the market start to rise, then more just political fears. Are we actually going to shut down? Are we not going to be able to pay our debts? Market started to fall. And then what we saw, again, this is what I was talking about on Thursday, all of a sudden the Republicans come out and say, we're willing to extend the debt ceiling until the end of November. The market clearly was not expecting this, and we just shot up dramatically in the S&P 500 just across all the markets. Then we do see a little bit of petering out and fizzling through the end of the week, but still up almost 2.7% for the week. So a really strong week in itself. Now let's talk about the jobs numbers that came out today and why it's potentially so troublesome. So just top line number, what we see, total non-farm payroll employment rose by 194,000 jobs in September. The market was expecting over 500,000 jobs, and some economists were even hoping that we would get close to 1 million jobs added. So to come in at 194,000 is far below what we were hoping for or expecting. Then as we scroll down, what we see that's even more worrisome is average hourly earnings for all employees on private non-farm payrolls rose by 19 cents to $30.85 in September. Now that puts the Fed in actually a really tough position. So what happened was we missed on adding jobs, but inflationary pressures or wage growth actually was higher than we were expecting. So we're seeing higher inflation with less jobs added. So it's kind of just a mess to be at the Fed right now. Normally, you'd like to see something like, what if we added 1 million jobs and also had a ton of wage inflation, well, then it's easy. The Fed just says, all right, we might taper sooner. We're definitely going to taper. Maybe we even raise rates sooner. Would the market love that? No, but it's at least a clear signal. Or the opposite. We only add 190,000 jobs, but we also miss on wage growth. Well, then we're not worried about inflation or that inflationary pressure. And so, sure, maybe we actually wait to taper until January, or we don't raise rates for longer. But now you have the Fed in a very precarious situation where, okay, we're not adding to jobs in the way that we wanted to, but the wages are going up higher than we expected. What do we do? And I think it's kind of almost put the market in a confused situation where we started off on Friday. We actually saw tech start to lead the way. It was doing really well. And then it almost flip-flopped in the day. The NASDAQ ended up down, the S&P 500 and the Dow both ended up positive. I'm not sure if the market fully even knows how to digest this, but going forward, if we move past this catalyst, we didn't see a massive sell-off, so the market clearly isn't terrified by this. The only big catalyst that I see right now on the horizon is CPI data that comes out next week. So next week's a big week, but after that, let's say CPI doesn't come in exponentially high and the market doesn't worry. I think we could see a pretty strong rally to the end of the year. However, if CPI data comes in high, people are worried about inflation. Oh my goodness, prices keep going up dramatically. Then I think we could actually see a pretty dramatic market sell-off. But compared to a month ago where we had so many other worrisome fears of the debt ceiling, stimulus packages, China, Evergrande, inflation, to only have one piece left of inflation, I actually do view that the market is in a stronger position today than we saw a month ago. But we'll find out in a week or so. So that's a positive news going forward. Either way, really appreciate you tuning in to hear me ramble on about this data. As always, we're here to support you. Your money's here to support you. I'll see you again next week.